I will share with you is a talk based on work in progress with my co-author Vittorio Corvo in Chile. And it's based on work in progress, which focuses on Latin America largely. So the only moment I will talk about Asia is in the title, because what we do is a decade-long comparison about the performance of Latin America between the Asian crisis period and the current global financial crisis, trying to identify which are the main components and factors which make this crisis different. And obviously the subtitle, Is This Time Different for Latin America?, is borrowed from this fantastic new book by Carmen Reinhardt and Ken Rogoff on financial crisis worldwide, on 8 centuries, as they call it, of financial fall in the world. Their answer in their book is that this time is not different from previous financial crises in the world. My answer is the opposite one for the narrow question which I have here at hand, which is if this crisis is different in Latin America than 10 years ago. And why is this my answer? And I'm already anticipating some of the response, is because significant structural and policy changes have taken place in the region during the last decade. So the question is if the effects of the international crisis and also the intensity of recession is different in Latin America this time. And we address this question in 3 different steps. Number 1, we identify and we date both recessions. This is a problem simply because we look at the region at large, comprised by 7 key major economies, but this implies that for the region on average you have to do some effort in dating both recessions, which is different from identifying very simply from the data at the country level. Second, once we have done that, we propose and then we estimate a simple but pretty comprehensive performance equation or behavioral equation for GDP growth, which is based both on short and long-term growth factors, both cyclical factors that drive the short-term business cycle and long-term factors that drive growth in the long term. And then we take this equation and these results, which are econometric statistical results, and we apply them in order to identify the different causal factors that drive both recessions, the 98-99 recession and 2008-2009 recessions. And here, basically, we look at international factors, structural conditions, policy responses, which are partly endogenous to the recessions, obviously, in the region at large. Let me start with GDP growth and the dating of the recessions. Our country sample is comprised by 7 individual countries. They together, represent something like 91% of Latin America's GDP and maybe 88 to 90% of Latin American and the Caribbean's population in 2007. They are Argentina, Brazil, Chile, Colombia, Mexico, Peru, and Venezuela. Typically the focus of most analysts in the region when they look at a subsample of countries. They are the 7 largest economies in the region. Our time sample is quarterly data for all variables, for the long-term growth variables, for the short-term business cycle variables. It's quarterly data spanning 1990 to 2009 second quarter. We're just working at extending this with recent data for the 3rd and the 4th quarter of 2009 of last year. To date recessions, we follow Calvo and Eichengreen O'Rourke. So we do fixed effect spinal regression of GDP growth on 2 dummy variables for the 2 recessions. We simply do this in a way where we extend the endpoints of the possible potential recession period candidates by several quarters. The final dating is based on the largest and most significant dummy parameter estimates for dummies for the 2 recessions. And what we find is that we have 2 4-quarter recessions for the region at large. This is different country by country. But on average, for your average Latin American economy, you have 2 recession periods of similar length, which are 4 quarters. The so-called Asian crisis period, 1998 3rd quarter, extending through 1999 2nd quarter. And then exactly 10 years after, exactly 10 years later, we have the global crisis, recession, induced recession period, which starts in the third quarter of 2008 and extends through the second of 2009. Growth was lowered according to this very simple panel analysis. Was lowered by 7.6 percentage points within the first recession, 7.5 in the second. The choices here for the different alternatives of the recession periods is marked in the yellow upper right-hand cell there, where you find the number of 7.6, 7.5. What does it mean? 7.6 and 7.5% during each of these quarters is the reduction in percentage points of GDP of growth as compared to the rest of the periods, which are the non-recession period between 1990 and 2009. So in graphical terms, this is average GDP growth in Latin America. This is unweighted averages. So every country, Brazil, the largest one, or Chile, Peru, the smaller ones, they have the same weight. And the average you have then the first recession is marked by these vertical lines there. The first recession you see at the end of the 90s, and at the end of the 2000s, you see the second recession there in terms of the declining growth rates.
Why 2001 is not a recession?
It doesn't show up as a recession in terms.
It's almost as low as the other one too.
Yeah, but it's shorter. So it's basically also based on a length of period of minimum 2 or 3 quarters. So this is country by country. You see a little bit the great moderation going on, meaning the reduction in the second moment of GDP growth. The great moderation implies that the fluctuation in growth in Argentina, Brazil, and Mexico tends to fall. Argentina is a big outlier during the Argentine crisis in 2001, 2002. But generally, you see a compression in terms of the volatility happening over time, with exception, obviously, of our last global financial crisis-induced recession in 2008, 2009. And the same for the other 4 countries, Chile, Colombia, Peru, and Venezuela. You see a lot of volatility at the beginning of the 90s and then sort of compressing with some outliers there. Venezuela is one in the early 2000s. So this is how it looks like. This is the average GDP growth in Latin America around the crisis. The green line is during the Asian crisis, where average annualized, deseasonalized GDP levels growth rates go down during the Asian crisis from something like at the peak before the 0 quarter is the second quarter of 2008 in the case of the red line. It's the second quarter of 1998 in the case of the green line. So you see a significant commonality in terms of duration and even intensity of both crises. If you look just at the unconditional raw figures of GDP. Now let me go to the specification. As I said before, the specification is a very eclectic one, but based on notions of theory and a lot of cross-country empirical evidence of long-term growth and short-term business cycle output deviations. The difference is that we also include nonlinear interaction effects between some variables, and I will come to those and explain you which ones. And also we encompass and we test for structural changes and coefficients taking place during the 2000s as compared to the 1990s. Our data is an unbalanced panel starting in 1991 at most, but some countries we start only later because we have this hyperinflation period where many relations are meaningless in the early 90s, in Argentina, in Brazil, for instance, and go through 2009.2. Our estimation method is multivariate dynamic fixed effects, unbalanced parallel data, regressions. The specification, we basically have 4 types of variables, what we call X, which are long-term growth variables, which you find in the long-term empirical cross-country growth literature. Then we have K domestic policy variables, which typically drive the short-term stronger than the long-term. M is what we call structural variables, for instance, measures for openness. And then we have foreign cyclical variables. This reminds me of Liliana Rojas Suarez's classification because we have basically the same variables as she had yesterday, which is price and quantity, financial transmission, and trade transmission type of effects of the international crisis on the local 7 economies which we are studying for. In addition, we have interaction effects between M, the structural variables, and Z, the foreign cyclical variables. For instance, if the countries are more open, This may have a positive or a negative effect coming, which is enlarged by the openness of, for instance, terms of trade shocks or sovereign spread shocks. And this is captured by the MZ interaction terms in the second line. And finally, we also allow for structural breaks, meaning that our coefficient vectors, beta x, beta k, beta m, and so forth, we test for structural breaks in those coefficients taking place in the 2000s, consistent with the hypothesis that you did things differently in the region, and therefore this may have affected the growth behavior. Which are our long-term growth variables? It's the standard ones like private credit, secondary school enrollment, inflation rate, fiscal balance, and or fiscal consumption, which is down the road, and political certainty. What are what we call structural variables? Financial and trade openness, both independently, net external assets and international foreign reserves, which experience has told us that they may, as an investment into liquidity, they may be like a floating exchange rate, a buffer for the bad times. It's self-insurance. And then exchange rate regime, where a floating exchange rate regime as compared to an intermediate or a fixed regime is measured as something which potentially could yield higher growth, very much in line with the results presented by Sebastian in his previous talk. Foreign cyclical variables, here we have the chance of transmission measured by Liliana yesterday in her nice presentation. Terms of trade growth, growth of trading partners, and of world exports separately. We find evidence that they separately may affect capital inflows to the region at large and sovereign spreads at the individual country level. Finally, domestic policy variables, government consumption. We're also trying for government total expenditure and ex-ante real interest rates. These are the behavior of our time for the average Latin American economy, the average of the 7 countries of our 21 variables, which are on the right-hand side: long-term growth determinants, structural growth determinants, foreign cyclical variables, and domestic policy variables. I will skip that in order to share immediately with you and have a look, to have a latest specification. One is we do an unbalanced panel without structural changes. So structural changes, without interactions, without interaction terms which are blank, for the full period from 1990 to 2009. Then we do the same unbalanced panel, but we add interaction effects. I will talk about those. And then we do unbalanced panel with interaction effects, the third column, and allowing for structural changes on the coefficients after 2001. So let me tell you, for instance, and I will pick and choose just the exchange rate regime for the very simple reason it was something which was presented by Sebastian too. The exchange rate regime we get is a dummy variable which has a 1 if it is floating and a 0 if it is intermediate or pegged. And if you look, controlling for all other factors, if you look if it has affected growth over the 20 years in Latin America on average, the answer is no, because whatever the little number is, it's not significantly statistically different from 0. However, if you distinguish the period of the 90s from the 2000s, in the 2000s, a floating exchange rate contributes positively, significantly at 1% statistical significance to growth. So there's a structural change. So in the 90s, it did not matter much if we had an intermediate, a tablita, an exchange rate regime, or a fixed one, a la Argentina, but it mattered certainly the heterogeneity in experiences after 2001, when many countries had moved to a float, but not all of them necessarily have moved to a float. 5 minutes, thanks, Eduardo. So this is the method which we apply for all other variables. We test for structural changes. We consider interaction terms. For instance, if you look, we have 4 basic interaction terms. If you look at trade openness per se, trade openness helps. It's significant and positive for growth. It helped more in the 90s than in the 2000s, but it helps. If you look at growth of trading partners is significant, important, even with a significant and large coefficient of 0.3, so it's economically important too. Now, if you interact trade openness with the growth of trading partners, knowing that both of them are independently significant, there is a positive and very large interaction term. So open economies, when they have a favorable trade shock in terms of a higher demand for their exports will benefit twice, if you want, beyond the effect of the trading partners growth and beyond the openness, trade openness factor, which is measured here. That gives you a feel of the type of method which we apply here for our 4 sets of variables: long-term variables, structural variables, foreign cyclical variables, domestic policy variables, and the 5th set, which is these 4 interaction terms, which are all are pretty give pretty sensible results in terms of magnitudes and coefficients. I will skip the basic discussion of the significant growth factors in the 90s and in the 2000s, a part of saying that foreign cyclical variables seem to be much more significant in the 2000s, which is something which will come out loud and clear now, looking at decomposing the amplitude of the 98, 99, and 2008, 2009 recessions to answer the final question, which is if the pattern of growth has changed in the region during the recent crisis. So in order to dissect the Latin American recessions, we will compare the growth performance. We do a simple within-crisis decomposition based on our basic equation. It's there. I will skip the explanation and also some of the numbers. But just to give you an idea, the simple average for the recession during the Asian crisis, 1988, 1999, is a decline in growth. A simple average of these 7 numbers gives you -3%, and the same number by sheer coincidence of -3% you also have during the second recession, the most recent one. If you do a weighted average, where therefore Brazil by size is much larger in the weighted, and Mexico is much larger than the other countries in the weighted, you see that the weighted average is -1 in the first recession, -3.5 the current recession. So this implies that from that point of view, the weighted average implies a much deeper recession now than before. But our methodological analysis is based to give one country one weight only, the same weight all countries. So we will look at numbers which are the 299 and 298 decline, cumulative decline in GDP levels during the 4 quarters we're speaking about. So now let's decompose. What are we doing here? We're comparing simply the 4 or 5 long-term variables and their contribution to this -2.99% in 1998. So let's look first at the deterioration in long-term variables like private credit, inflation, secondary school enrollment, fiscal balance, and political certainty explained a lot. Of this 2.99, 1.6% is explained by the contribution of a deterioration in long-term variables. Why now it's 0. Now, during the most recent recession, we didn't have a significant deterioration. Some of them, yes, others not compensate. On average, 0. So our long-term variables did not deteriorate during the current recession. This is something which is very positive, it's very good. It explains that our long-term growth variables actually did not move much during the recession, did not contribute to the depth of the recession. Structural variables did somewhat worse during the recession now than the recession 10 years ago, but it depends very much on which variable we are speaking about. Trade openness declined more significantly. Why? Because trade openness is measured at X plus M over Y, and that actually was affected very significantly, very deeply by the current recession because of the collapse of world trade during, and therefore also Latin America's exports and imports during the current recession. Foreign cyclical variables, huge difference. Look, the world conditions improved for Latin America during the 1998-1999 East Asian crisis. On average, yes, we had a deterioration in sovereign spreads, but on the other side, growth of world exports was positive, growth of trade importers was positive, and therefore, combining all those, our foreign conditions improved, weighted by the coefficients estimated by us. The foreign conditions improved during the 1998-1999 crisis, while the foreign cyclical variables now deteriorate very, very significant. This is very much a deeper, a true world recession affecting the region, using our 5 channels of transmission a la Liliana Rojas Suarez, which she presented yesterday. So this explains 2/3 of the recession. Domestic policy variables deepened the recession, basically because real interest rates were raised and therefore the recession was deepened by defending fixed exchange regimes. Example, my country, Chile, for instance. Why this was not the case now, and actually fiscal policies helped, a bit less than then, but combined both of them, the recession was dampened by the domestic policy response. And finally, interactions we have, I will skip this, not much contribution. So let me skip most of these detailed explanations of the difference between both recession, because I think you got the most important out of that. And therefore, the main question about Latin America, if it is different now, as opposed to Carmen Reinhardt's and Ken Rogoff's book about the financial crisis, if that's different, the response in Latin America today is very different. It's very different because LATAM has improved macro policy frameworks, strengthening macro regimes by shifting from less discretion to more rules. Also in terms of exchange rate regimes, adopting largely dirty still, the exception is Mexico, largely dirty floating exchange regimes. And this is an effective dampener of foreign shocks, as discussed by Sebastian, and strengthening monetary policy regimes by adopting full-fledged versions of flexible inflation targeting. Also, structural conditions have improved, and very importantly so, and therefore have shielded more effectively the region from the very, very deep international recession, strengthening the global links through trade and financial openness, strengthening external positions, especially foreign reserve positions, which is consistent with the dirty floats by accumulating, by intervening in exchange rate markets. More openness has helped long-term growth, but partly exposed it more to the effects of adverse foreign shocks. And this has also helped a lot. However, very important to note, Latin America is not a homogeneous region. It's very, very heterogeneous, exhibiting large and possibly increasing heterogeneity over the last 5 years in regimes and in policies as well as in poor funds records. So the average has improved, but with large heterogeneity between, let's say, the Venezuelas on one side and the Perus on the other side. Latin America still faces a long agenda of economic and institutional reforms in order to spur growth and raise its resilience to foreign shocks even further. And I would just finish by saying there are 3 basic major items on the policy agenda. Number 1, we got to continue improving our macro-financial policy framework, hopefully adopting full-fledged IT, and or maybe price level targeting in the near term. Clean up to the extent possibly once we have accumulated a sufficiently large liquidity in form of international reserves or sovereign wealth funds, clean up dirty exchange rate floats, adopt fiscal rules and policy regimes. This is something very much on the agenda, and this crisis has made one weakness obvious, which is that our fiscal policy regimes are much less counter-cyclical than what is desirable and necessary in order to counteract foreign shocks. And finally, also on this issue, adopt the world's very much still evolving best practice, not so only macroprudential regulation, but also in financial and capital market regulation. But these are changes where our 3 seats of the region on the G20, which means Argentina's, Brazil's, and Mexico's, are very important to take part in this international discussion. Second point, deepen globalization. There has been massive unilateral trade and financial integration. Peru is a paramount and very positive example through free trade agreements, through unilateral reduction of tariff protection, and through structural reforms for growth. As a region, we're still a growth laggard. The only successful growth miracle of the 2000s in all of this region is this country, is Peru, because they have done the right reforms, maybe a bit later than other neighboring countries like, for instance, Chile, or Mexico North, some partial reforms, but they have done them very successfully, and therefore your growth in Peru has been really the outlier in the region, but certainly growth in the rest of the region is extremely low because we still have in place a lot of micro distortions. Our level of education is at a dismally low level. Government reforms are very much high on the agenda, and a lot of things are to do there in order to make the government function more effective and growth supportive, and therefore I think, and with this I finish, I think this is part of the development and pro-growth agenda which we are facing now and for the foreseeable future in the next decade maybe. Let me stop here and thank you very much for your attention.